not the time to be cutting rates, and hikes are still on the table. Well, that was the hawkish message from Fed Governor and voting member Michelle Bowman today, further raising the stakes ahead of the next critical inflation report, which comes this Friday. Joining us now is Mohamed El-Erian, Chief Economic Advisor at Allianz. Welcome back. It's good to see you.
Thank you. Thanks for having me, Scott.
All right, PCE on Friday. Let's just kick this around. If that comes in favorable, okay, should the Fed consider cutting in July?
In my opinion, absolutely it should consider cutting, but I don't think it will.
Well, why do you say it that way, that absolutely they should consider cutting in July?
So just think of the conversation you had earlier. You had disagreement about what's happening to inflation dynamics. You had disagreement about the growth dynamic. You even had disagreement about the impact of lower interest rates. We're living in this very uncertain world. If you look at the tails of the distribution, which you worry about in an uncertain world, they're heavily tilted in terms of the economy slowing much faster than people expect. In such a world, if you want to deliver a soft landing, you've got to start cutting sooner rather than later and not go too far in cutting. So the most likely mistake right now, the most likely policy mistake, is a Fed that got shaken by two pretty bad calls in the last few years, will end up being overly cautious and will end up not helping to preempt what could be a significant slowdown.
You used the word I was going to use. So you think that they should do a preemptive move to cut rates to protect, in quotes, the economy?
Correct. So I have two views. One is I think this economy is slowing much faster, and in particular, the household sector no longer has excessive savings, no longer has much debt capacity. This is not about a K-shaped economy. This is about an economy that no longer has buffers. So if the Fed gets the labor market wrong, we are going to have a much faster slowdown than they can even imagine. So that's the first issue. The second issue, which is much more controversial, is that I don't think 2% is the right target. I think, in fact, if they pursue 2%, they'll run an over-tight monetary policy, and they'll end up sacrificing the second part of their mandate. This is an economy whose underlying equilibrium inflation rate is higher than 2%. It's closer to 3%, Scott.
So it feels like over the last couple of days, at minimum, I'm talking about, the Fed speakers that have been out, between the interviews that Steve Leisman, of course, has done. There was, Austin Goolsbee yesterday. Do you feel like the conversation is starting to tilt towards the idea that we have to be especially careful of the risks of waiting too long to start cutting?
Maybe at the margin, Scott, but not enough. And there's a reason for this. We've had so many monetary policy pivots that it's embarrassing. It's absolutely embarrassing how often this Fed has pivoted. And the big mistake, its recent mistake, of course, its big mistake was 2021, when it called inflation transitory. But let's not forget that it fell in love in the fourth quarter with soft inflation numbers. It embraced them fully and then had to reverse again. You talked about with Lizanne earlier about the market going in with 6 to 7 rate cuts in terms of its expectation. That's because it believed the Fed. And the Fed was saying, I love what's happening to inflation. And then, of course, they got the shock of January, February, and March. So this Fed feels burnt and therefore is not taking enough of a strategic view of the economy.